I think what's important to note is that the Fed has not been tightening policy. Okay, they've been removing excess accommodation and they've been moving to neutral. What we heard on October 3rd from Powell was that he actually is thinking about tightening, and that's the move from a 3% nominal Fed funds rate terminal to 3.5%. So that 50 basis points extra, that's not in the market. That wasn't priced in. The bond markets reacted very, very quickly to that. Yields rose. And then the equity markets reacted slowly at first and then all at once last week. So I think what we're really adjusting to mathematically is just a rise in the risk-free rate, the possibility that the risk-free rate actually might move into tightening territory. You've got to discount those cash flows at a higher interest rate. That's going to lower the present value. That's going to bring down the stock price. But if economic growth continues to be strong and continues to be good, then I think that we can resurge from this. So I view this move as mainly technical and not fundamental.
So I understand. So the recalibration of the risk-free rate of return causes the initial break, but then fundamentals take over, earnings go up, which we saw this week. We saw some earnings, and suddenly we snap back.
Right. So there's probably some pain. There's probably some overshoot. There's probably some liquidations, and the markets are going to be noisy for a little while. I mean, it's October after all. This is supposed to happen in October. But once that gets settled down, and we realize that we're on track to grow at 3% plus this year, and maybe a little higher than 2.5% next year. And if earnings are good, hey, I think that we can rebound from this.
And we've seen, you don't think the VIX ends up being a predictive of anything, and I don't think you do either, do you?
No, the VIX, I mean, in terms of the VIX, I mean, it's a coincident indicator. So the fact that it's moved up a little bit just tells us that stocks have been a lot
that one day.
Stocks have been volatile. That's what it's telling us. Interestingly, when it gets to very high levels, that tends to be a bullish indicator. So we didn't quite get to there. But besides the 10-year, I also think the other information we got over the last couple of weeks is that there's increasing concerns about how trade and tariffs are going to impact things. A couple of industrial wholesalers have been talking about that a little bit more. There's pockets of uneven growth in the global economy. So I'm not sure it's only the 10-year. I think there were some questions about the growth outlook, and that's why we saw more of a defensive rotation.